The FOMC meeting concluded today, and the market was steady after the statement was released. However, once Powell got up and started answering questions, the market started to sell off as a result. And so in this video, we are going to go over all of the main points that you need to know about what Powell said during the press conference today. Ready? Let's dive in. All right, the first thing that you need to know that was reiterated over and over throughout the question and answer period was that they're going to go by the incoming data and adjust their plan as necessary. And if the data indicates that they need to change their path, then they will. The only thing that they've outlined that they are definitely going to do at this point is reduce their asset purchases so that by early March, they are done purchasing assets and their balance sheet will no longer be expanding. It would just be moving flat after that. They have not made any decisions on the exact timing of rate hikes, although it is likely that they'll do 3 rate hikes this year. The market is actually pricing in 4 rate hikes of 0.25% each, which would give this year a 1% raise total. The second thing that he reiterated over and over and over throughout the question and answer period was that the economy is strong and the labor market is an extremely strong labor market, and the economy overall needs less accommodation. Now, I don't know exactly what data they are looking at when they're saying this is such a strong economy, but it is likely not the metrics that you or I would look at. Now, he did make a caveat, which I thought was very interesting, and he said that the labor market is strong given the high inflation right now, which indicates that if inflation was lower, then they'd look at the reality of the jobs market, which is the labor force participation rate being so much lower than it's been for years prior to March of 2020. There was a massive drop off and it has not recovered anywhere close to where it was before. So given this stance, you might wonder what they are looking at to say that the labor market is strong enough, and it is simply job openings. Job openings right now, there are a lot of job openings. That is true. People are not taking these jobs. So despite the fact that the labor force participation rate is down, it's not necessarily because there just aren't any jobs available. It's because people aren't taking these jobs. So the Federal Reserve is looking at that fact and saying, hey, well, we've got job openings, so we've got lots of room to attack inflation until these job openings dry up. And then if the jobs market still hasn't come back, if the labor force participation rate is still way down, well, then we don't have as much room to attack inflation anymore. But while there are jobs open right now, then clearly there's some strength. Otherwise, people would be taking these jobs. They wouldn't, feel comfortable just staying on the sidelines out of the labor market. Now, regarding their balance sheet, they were asked about their plans for shrinking the balance sheet. And right now, again, the only plan they have is to stop their purchases by early March. After that, at some point, they'll start letting their balance sheet shrink. There are a couple of different ways to do that, and they haven't decided what they are going to do yet. The first way is just letting all of the debt mature naturally and not replacing it. Remember, if the balance sheet never grows or shrinks, well, what is the balance sheet made up of? It's made up of debt. And what happens to debt? It eventually gets paid off. So any of these short-term bills, if they've got 1 year, 2 year treasuries that are maturing, when they mature, that principal is paid back. And so that debt expires, it disappears, it goes away, it's paid back. And so their balance sheet would start slowly decreasing over time as those loans are getting paid back to them by the government when they mature. So if their balance sheet is moving sideways, that means they're replacing those maturing loans. They're still buying new loans as they mature. And so if they're letting them run off kind of passively and they don't replace them when that debt matures, then their balance sheet would slowly trickle down. Again, slowly, if they do absolutely nothing, it would probably be a little bit volatile because it just depends on the composition of the assets on their balance sheet, the maturity, the distribution. But in general, you would see a slow decline on their balance sheet. The next option is an active selling. So instead of just letting the debt mature, they would actively sell assets off of their balance sheet back into the market. This is highly deflationary because what you're doing is you're sucking money out of the system. Just like when you are playing Monopoly and you buy an asset, you buy a property, you pay money to the banker, that's money leaving the game. That's money leaving the table. And so that causes prices to go down, asset prices, prices of goods and services, because because there's less money chasing the same or higher number of goods or services, and so what that pushes prices down. That's the force that it has on the market is pushing prices down. And just like in Monopoly, it eventually causes somebody to run out of money and go bankrupt. In Monopoly, the game ends, and in the real world, that's when the game of tightening ends and they step back in and bail out the entire market. Now, the third option that they have for letting their balance sheet shrink is what some have called Operation Twist. It's just changing composition. So this could be a combination of active and passive, where they're letting everything mature slowly, but instead of just letting everything mature as it is on their balance sheet, then you might have a really volatile drop. Some weeks or days or months, you might see their balance sheet drop significantly, and then other weeks, not a lot, because they just don't have anything maturing then. So what they might do is they might look at it and try and smooth that shrinking of their balance sheet out by, if they have a week where a lot of debt is going to mature, they might buy some of it back from the market, some new debt, and then on weeks where they don't have anything maturing, they might sell some onto the market just to smooth out that average ride. So it's possible they do a combination of this, and then they can also look at how it's affecting rates and specifically sell longer term debt or shorter term debt in order to avoid a yield curve inversion or something like that they don't want to see. And that's simply to make sure that longer term rates stay higher, a little bit higher than the shorter term rates, and so they can sell appropriately to provide the right market pressures on the parts of the yield curve that they want. And so that's the summary. That is the main points. That's the meat and potatoes from this press conference, and everything else was basically fluff. The main two things to take away are that they're eyeing job openings for the most part to determine the strength of the labor market, which is giving them the room to attack inflation with tapering their asset purchases, selling assets, raising rates. They don't have an exact plan laid out for anything yet other than reducing their asset purchases to zero by early March. After that, they'll continue eyeing the data, but it looks like they will probably start raising rates and shrinking their balance sheet after March. Towards the end of the year, we'll probably be seeing both of them. Again, all of this is eyeing incoming data, and they've said explicitly, if something else happens, if new risk pops up, they will pivot and do something else necessary to combat whatever risk pops up. They've stated that explicitly, and that's what I expect as well. I expect this tightening to cause some sort of a crash, and that's when they'll step back in with QE infinity. As always, really appreciate you guys. Thanks so much for watching. Have a great day.